get clear on standards, not goals, standards. What are the standards we're going to hold ourselves to? So if we hit those standards on a daily basis, it's inevitable for those goals to be achieved.
I can't take no loss. I don't even know what it costs.
All right, before we get into answering the questions of how does it feel, what's changed post exit with Elevar, Nate, I got a quick story. So for listeners, we are not fitfluencers, if that's a term. This isn't a fitness podcast. However, we are both into High Rocks. We're not High Rocks athletes. We've finished the finish line a couple times, barely, for Nate. And the big things I'm focusing on now is getting my run time down to like 36, 37 minutes. So I need to drop like 6 or 7 minutes. So there's this concept of speaking what you want into reality by telling it to the universe, which I learned from Dan Martell. I've been working with Dan for 5 years, Dan does a million things, but SaaS Academy is really his big thing, which I also coached other SaaS founders in there for a couple of years. But he taught that years ago. It's just, if you want something to happen, just speak it into reality, tell people around you, and it'll happen. So Nate, you got to hold me accountable here. I'm going for a sub 40 minutes. I'm following a program from, I think, Run Energy on Instagram to get a sub 40 minute 10K, and hopefully it transitions into High Rocks. But anyways, speaking things into reality, I think, is also something that you follow as well. Correct, Nate?
Yeah, and I'm more about the accountability that stating things publicly creates. I heard Jim Carrey tell Oprah one time that you can't have a dream and say it out loud and then go make a sandwich. So you have to actually put your feet on the pavement and move your body, and you're going to work towards this goal that you stated publicly. So I'm a bigger believer in accountability and effort, getting people to achieve their goals more than just saying it out to the universe. But I definitely think that now you've said it publicly, you are destined to get to that higher goal for sure.
I got 60 years. All right. So we'll talk a little bit about the 90 days before exit and the 90 days after. But just to give everyone context, so a little bit about me, I've been in startup world for 17 years and started Elevar 7 years ago. So Elevar is a bootstrapped SaaS company. We serve Shopify brands through better tracking. And the 17 year process for me goes back to my first startup, which was also in SaaS and e-com. I'm not going to get into that story yet. Go to bradredding.com and you can read more about that. But for context on Elevar as a business, so again, we're in SaaS, serve e-com brands, roughly about $1 million in revenue and services a year, $1 million in usage-based revenue a year, roughly about 10 million ARR. And we exited to Buxton, who's a strategic. It's the way I describe Buxton is the Elevar for offline and retail data. So Buxton's been around 30 years. And they focus on large, the Warby Parkers, Anthropologies of the world. And now we are blending Elevar and Buxton to bring one-to-one personalization. So the whole exit and this merger is backed by PSG equity. So as of now, for me personally, I'm still on leading Elevar as we're going for a $1 billion company. Nate and I have been good friends for many years pre-Elevar. So Nate was actually the first person to sit down and click a button that was not the Elevar that everyone knows today, but it was the Elevar from, 7 or 8 years ago. And so at that time, Nate, you were running an agency, which I'll let you describe, what you guys were doing, but you had e-commerce brands. And one of them, that was one of your first companies, Juggernaut. So I think we'd hooked Juggernaut up to Elevar. You'd pressed a button, ran a bunch of data analysis, and you were like, holy cow, this is amazing. So that's a little bit of my backstory. Again, if you want to go in more detail, just go to bradredding.com for that 17-year journey. So Nate, what you got?
Yeah, for my background, just grew up in a family real estate business. So real estate was a thing I saw and heard for the longest part of my life. Co-founded my first business out in Orange County, California, 15 years ago. So I was applying to med schools, in the process of getting rejection letters from med schools, and finishing my MBA. Chad Smith, co-founder of Juggernaut, called me up with a great opportunity. And then I was 4 years into my next business in Charleston. That was the first time I ran Elevar. So when I was kind of on the other side of Elevar, Brad's, the wizard behind the curtain, basically. I'm running Elevar, and I'm making a bet on the founder as much as I was the product for Elevar. So I know we'll go into more details about what we've experienced. What's that, 7 years ago now? Yeah. So man, that's
Yeah.
a lot of days. Those move
Yeah.
fast. So what we experienced over those 7 years, it's definitely been like a lot of growing pains, a lot of wins, a lot of losses, and outstanding outcome that we dreamt of. And then since the acquisition, I've kind of moved back to, my first love, which is real estate. So a lot of things to unpack there as we kind of work through the pod.
Don't let Nate undersell you. There are more Winkler signs in Boone than there are Boone signs.
There's a few.
Yeah. All right. So everyone, again, just to reset the stage, the most common question that I've received, and again, this is from colleagues, teammates, managers in Elevar, my family, friends, folks in my SaaS boardroom group and other masterminds. It's, hey, like, how's it feel? What's changed? And the reason for sharing this is there are so many founders, business owners, people like me 15 years ago who I was working at this in between startups. My first startup was 17 years ago. Then I had a 5-year stint working at an agency here in Charleston. So I also was an employee. I'm a little bit older now, not that old, but a little bit older now.
A bit older.
Yeah. I'm not 25 anymore, but I think sharing some of this of what's life like after, but more importantly, pulling it back to what was the 90 days like before is important for anyone who's currently running a business. That when I would listen to these podcasts from people who are in the place that we are now, it was very motivating to me, but also as someone who always had an itch for entrepreneurship where I wanted to get into the startup game and build a business, whether it was, a side hustle consulting business or a full-fledged software business. There's so many stories that I want to share and give back and pay it forward to others because I leaned so heavily on so many people for so many years to help us to get to where we are today. So Nate, what are some of the questions that you've gotten again after the news came out and this, and then we'll get into actually the 90 days before we actually went through this process.
Yeah. So 90 days before, I know we were working towards acclimating ourselves to a different reality of having the ability to be investors, to have, the means to invest. The 90 days post transaction for me, a lot, it's been, what am I going to become? What's my new reality? How am I going to spend my days? There's been, we talked about this a good bit, but there's been a lot of deal flow. So there's been a lot of opportunity. And I think one of the things I'm learning most is, not necessarily to protect my wealth. I don't have a defensive mentality, but it is to understand that like there's unlimited opportunities out there. Which ones are you going to put your money and your time into? Because those things are limited. No matter how much time or money you have, they are not finite, or they're not infinite things. So that's really what I've spent the bulk of the 90 days on, is like this new reality of, okay, how are we going to invest? How are we going to turn 1 into 2 and 2 into 4? And who do we invest it with? Where do we put our money into? I know we'll get into this in this episode and others. There's a lot of opportunities with stocks and real estate and other businesses and all. So yeah, it's the first 9 days have been a lot of learning for me, not a lot of talking.
Yeah, finding your investor DNA, which that'll likely be a future episode. We'll get into the meat of that one. So let's go back to the 90 days before. For context, in running Elevar, so again, we were bootstrapped, and on the financial day-to-day and forecasting, my default was always, how can we invest more into the business? Because the ROI on that is always going to significantly outplay if I take money out and put it either in the stock market, in a savings account, invest it somewhere else. The ROI is always going to be significantly higher reinvesting it back in your business, because growth, obviously, if you are reinvesting back in the business, the plan is to get more growth. So accelerate growth, which then you have multiples that'll come into play if and when you do go through an exit. And what that meant for me personally, and Nate, curious to hear your perspective on that as well. I got very comfortable with living as a family of 2 young boys, 4 and 5-year-old, but when they were babies, I got very comfortable living with, I never had more than $10,000 in my savings account, in our savings account. That stressed the hell out of my wife, but it was
Hmm.
such a norm for us because the first 3 to 4 years of the business was, I mean, we were, uh, there were so many uh, reasons why we should have gone out of business, from taxes. And when COVID hit, I was already forecasting a down year, and then everyone stopped paying us for 3 to 4 months. So again, I think just getting comfortable with risk, like just accepting that there is a ton of risk, but I'm betting on myself that reinvesting back in the business is going to prove out 100x more than having a safety of, instead of 8,000 in my savings, I have 80,000, because that's really not going to change anything. So what, again, just to give context on you, what was your, where was your head at?
Yeah, I mean, I think both of us, from the day Elevar became a real legal entity, I think we were all in to Elevar. I think we knew that I had confidence that you were someone that could be trusted. And for me, it wasn't so much of a risk financially. It was more of, when is this transaction, when is this outcome going to come about? And can we exist financially as a family until that outcome occurs? So it was definitely like a time game, and we were in the same places as y'all were financially. It was extremely, we were bootstrap businesses and bootstrap families. So
Yeah.
I think it's important, if you're like us where you haven't had an outcome yet, it's committing to something that you know you're into and you're going to weather some of the storms, and you're only going to try to go all in on one thing. And I think that's something we've learned from advisors post transaction and
Yeah.
even before that. It's like, don't put 12 eggs in 12 different baskets. Go very deep and focus very intently on one thing, and do that very well, and then start to diversify and grow from there. So I do think we, dumb lucks, blindly did that correctly, and that ended up,
Yeah.
turning out well for us. Because, like you said, you can 100x a business, you may be able to 1 or 2x a real estate investment over the course of years.
Yeah. Yeah. And I think that term in the business world, I mean, the Hormozis and others, they really push on this as well, as the niches, the riches are in the niches. And I, I can even tell you, by being in SaaS Academy and coaching other founders, and they would come to our sessions and ask, hey, I have this other business idea, and they're starting this other business. I'm like, dude, you're only at 2 million in revenue. What, and your growth rate is 20%, 30% year over year. Why are you going to start this other thing? Or maybe they're at a million or less than a million. And it is so easy to fall into that trap, because even when you do start a business and you get a little bit of traction, you have opportunities. So people are like, hey, what do you think about starting this? And you're like, oh, I can do that. I just did this. And I think the point you made of, we didn't fall into that trap of taking those opportunities on, and just, it's really cutting the fat of everything else that we're doing and just focusing in, is a great one. Anything to add to that?
Yeah, and I think even post transaction, like, that's one of the few lessons, other than, this brick by brick mentality that is just ubiquitous in life. But before your first transaction and like great win, focusing and doing one thing really well is going to be to your benefit and the business benefit and all your employees. And then after the transaction, we've heard this from a number of people that are, financially much further ahead than us. You can only say yes to a few things as well. So if you
Yeah.
go and you start, splitting things and your attention and your brain cycles to 50 different investments, all those are going to do poorly as well. And Garrett Gunderson made a good point to me a couple weeks ago. He was like, okay, say you can make small bets in 50 different companies. He's like, do you want to be on 50 different boards? Like, do you really
Yeah.
want to sit in those chairs and process and, advise people that you've invested in their business in 50 different meetings a week or every 2 weeks? So I do think that is a common thread on both sides of this acquisition fence that I've noted along the way.
Yeah. So the other question, I mentioned in the beginning, the two most common questions are, how does it feel? What's changed? I would say the third question is, why did you make this decision? And we started out the process with a banker last summer, so June-ish. But at that point in time, we were considering, so we, again, bootstrap, never took any outside capital. that was by choice. It wasn't like they're just hundreds of emails per week in my inbox looking to give us money, but we chose not to for the reason that we wanted to remain in control of all of our optionality. So we wanted 100% control of optionality of whatever we wanted to do, whether it was I want to throw a customer conference, which is going to cost $200,000, or we want to make this other hire, or we want to pull a bunch of money out because we're having a life event. But getting back to the point of the decision last June, it was just speaking for me personally, very much around, okay, we've continued to push all of our chips back in the table over and over week, month over month, year over year. And I like to describe this as you have your resting heart rate. So if you have an Apple Watch or whatever, you have a resting heart rate where it's like, you're 55 or 45, whatever it is. I always had a resting stress rate of 3 to 4. I could be in the middle of the ocean catching marlin and having the best time of my life. But I was always thinking, what if this customer leaves us? What if this person leaves us? What if this? And I'm a very optimistic person. I'm more of a glass half full than half empty, as evidenced by not taking any money out of the business and just continuing to bet and having, $5,000 savings. But that was always something that was with me, and I could see it starting to wear in my family, and also just getting to the point like we got to 10 million in revenue, but if we want to get to 100 million, bootstrapping that is very hard. It's a very, very long way. So what was your feeling going into last June, where the rubber was meeting the road of like, okay, do we want to go this direction, or do you want to take VC money or angel money and take some secondary just to take 20% off the table and put the other 80% in the middle? Where was your head at? Maybe going back a couple of years as well.
Yeah. So I always mark June 1, 2023 as like that inflection point, because the business had been growing. Ironically, COVID was like a springboard for us, for a number of different reasons, but we just like hit the accelerator when we got to COVID. And then the year before that,
iOS and all the iOS 14 changes.
Yeah. Yeah. So like 2020 was just like this like incubator springboard, just things fell together. So we were, even in 2022, we tried to go to market then, and that was right as like all the financial crisis happened. It wasn't 2009, but it was not a good year. The markets fell, and so multipliers fell and everything. So we were making the decision on June 1, coming off the backs of that and understanding like, hey, if this doesn't go well, it's a very long, cold winter to go, all the way through the next round of, acquisition timelines, because these things happen in windows. So we had, you'd been building a relationship with some investors. We got a reasonable secondary offer, and it was something that we had to take a hard look at. And it was definitely this inflection point of like, okay, do we want to go all in again and push even more chips on the table? Because if we don't get acquired, what is that going to demand of us to like continue bootstrapping this business? And how are we going to get to 10 million ARR and hit our financial goals while still being self-funded? So it was a really, really tough set of decisions. I remember I was on vacation. We'd come down to a place close to Charleston where you live, and you and I talked on the phone and Slack and text like 4 hours a day when I was on that vacation.
Yeah.
And, we both got up one morning after like a couple of late night conversations, and like we both were like, easy, not even looking back, let's go all in. I know our banker had, Babe Ruth called his shot, which came out to be right and everything. So yeah, we definitely, when you go all in poker, you're judging based on what you have in your hand. So you do have some data, and we were also feeling a lot of tailwinds. So it wasn't a blind gamble by any stretch of imagination. We knew like the market was coming around, Elevar's growth and Elevar's brand recognition. So if you're thinking of timing up when you're going to take your own business to market, like there are definitely going to be some tea leaves that you can read with your business to know like, okay, I've got a lot of momentum. Because when someone's acquiring a business, they aren't just purchasing, your financial performance at that single point in time. They're looking at a lot of like future potential, and what is the trajectory of this brand? Is this a plane that's taking off, or is it landing? So we'll get into tons of that stuff because I mean there's a lot of details there and that go to market. But that's what stood out to me a lot was that morning. I think you and I both had a real sense of peace of like, okay, we're going to turn down secondary. We're going to, have another risk round from ourselves and move forward here and see what this outcome turns into.
Yeah. Yeah. And a lot of businesses, you have partners. And I think that's one thing that Nate and I have done really well over the years is we stay in lockstep, and there's been minimal of probably zero infighting. There's just been a lot of we keep in communication, we respect each other. Not that we both agree on the decision. I think even that story you're just explaining, at one point in time I was seeing the world or the future in a little bit of a different manner than you were, but we worked through that. And that is something to just keep an eye out on is you have to be clear on what is your end goal. And I've seen a lot of other businesses where that has caused fractures and failures and buyouts, which cause stress, and businesses don't grow quite as fast because of those issues. It's taking up mind share. And so I think really whether you're just getting started or you're in the middle of, just get very crystal clear with your partner on doesn't have to be your end goal, but what is your 3-year plan? Do you have a 1-page strategic plan that goes through your 10-year vision, your 3-year vision goals, and then what are you executing next year? Because if you don't have that, then you will likely end up being on different pages, which is going to cause some friction. There's a great book called Rocket Fuel out there that I read years ago, and that set my mind right away into, okay, we've really got to be crystal clear with each other, and even team folks on all of our management team, to just understand where are we going, how are we going to get there, because you can't have two visionaries. You can't have two visionaries in a company.
Yeah,
like the concept is visionary and an integrator, which for us, like David transitioned really into our core integrator at Elevar. But yeah, anyways, you're going to say something?
Yeah, a number of things from that. I do think it's key from the very beginning that there is one visionary and there is one leader. And for me, you were someone from day one that I knew I could trust. And I think Elevar, our partnership, the outcome, everything benefited from that, because I've been in other partnerships where there's just too many cooks in the kitchen, and it, confuses your team. It confuses the vision. It makes like the partnership strain, all that. The other bit, if I had to do it all over again, I would still do the bootstrap self-funded, because it was so difficult in so many ways, so many weeks. You would message me and it's like, man, we've got to grow in order to pay our bills, not to for me to go buy another car. So I do think, I'm saying that with a clear mind of there was a lot of struggles along the way, but early on when you're growing, having a very small, tight-knit group of founders or partners, like a lot of our board meetings for you and I occurred over voice memo or Slacks or text.
Yeah.
We would align quickly. We would align frequently, like you're talking about being in lockstep, but that benefited us so much because there wasn't so much formality around our vision, so it's like a small boat, a John boat can divert quickly. And if it's a cruise liner, it takes forever to make any changes. So I think we will get into that more and more as the podcast evolves, but I think all things considered for us, self-funded is definitely what I would recommend. I don't know about you.
Yeah, because it worked out.
That was a pause. Yeah.
I would again. I mean, for sure now, but just to put in perspective again, for the risk tolerance, I've cashed in 2 401ks to fund my 2 businesses. So I still don't have a 401k. I'll never have one. But that was, you might be wondering, well, how did you get the business off the ground with software? And we had debts of, $200,000+, and that money has to come from somewhere. It either comes from taking on loans. So we did Stripe Capital, which is based on the cash flow coming in. We were getting loans from Stripe Capital. We funded ourselves. So it's like taking money out of either a 401k or money that we do have, putting that into the business to, again, pay team members, or it's just GSF&D and just pull in revenue any way you can, which for us, it was services. So I was all about services. Money, I can predict it. We can carve it out and use that to build a runway for software, and that meant a lot of Upwork weekends and Friday nights, and there are a lot of sacrifices. And this isn't going to go in that direction, but I think it's being reasonable. Bootstrapping a business, well, it's looked much more positively today because the way the market's changed the last couple of years, but it does come with certain risk that you have to have the appetite to swallow.
Yeah, and also think that being profitable is always something that you need to look at as being in style. So if your business is not performing as you think it should, like don't rationalize it or justify it. Like look at it honestly. And I know for us, like you and I were not people that camped out in our P&L. You had a super detailed budget spreadsheet that you manage cash flow every single month because that's necessity. But as like we worked through due diligence and we started understanding like this term, what is like the revenue quality?
Yeah.
I think that's something for us that benefited us a ton by just saying like, you know what, we're even when it wasn't cool in 2019, 20, and 21, like we're going to be profitable. And that ended up helping us a ton because as people run these projections, if you're not profitable, even if you're growing a lot, that makes your business look like a much higher risk investment.
Yeah, just go read Profit First and Simple Numbers. Just read those books back to back and just implement it into your business. I don't know what year we did that. It's probably 21 or 20, I think. And I think on the due diligence side, what was the quality of the revenue? 100%. So if you are thinking about your own perfect exit in 2, 3, 5, whatever many years, work your way back because as Nate said, that is going to be the core part of due diligence is looking at your revenue. And if you can look yourself in the mirror and say, I don't have any skeletons in my revenue closet, but if you can't look yourself in a mirror and be truthful and say, I don't have any skeletons in my closet, go fix those because they will come out. It's not like you give them access to your dashboard and they just believe what you say. I want raw access to all of your payment history from the day you started, and we will recreate our own reports and tell you what your business looks like. So that was a very stark reality for me that stood out of, wow, we weren't perfect, but I don't think we were anywhere near the end of the spectrum where it's like, man, these guys got a ton of skeletons in their closet. So I think it's just, you don't have to be perfect from day one, but just try to fix those gaps. Don't lie about numbers. I don't know. I won't go off on a tangent there.
No, yeah, you should probably because this word audit for me is something that I'm looking at in every aspect of the business, not just financial. So, you have these company scorecards, and I definitely stole that, and I'm putting that into my personal companies. And if you can't manage something, if you can't measure something, how can you manage it? And if you look at your P&L and if you look at your cash flow, like if you're not profitable, there's a reason for that. And that's why when investors ask like, hey, send me a P&L, they can look at that and they can quickly determine like these higher level metrics. Like if those things aren't checking out and passing the sniff test, like there's something wrong with your business. There's something wrong with your business model. And I think you did a great job doing that at Elevar, and of course, like the other folks you hired in leadership positions, where Elevar did not have this rigidity to the way it operated. It was always, this litmus test of like, are we growing? Are we reducing churn? Is our NRR where we want it to be? Like, are we profitable? Yeah. And those things, I think you call them North Stars, or maybe you had those in other areas, but those things are like the guiding principles. And everything else down below that, it's just up for debate and up for adjustment. And I'm the same way, and my hospitality businesses and things like that. What I care most about is, are we making more money for the owners? Is there profit being turned? Is our occupancy going up? I don't care about these rules I've set before. Those can be adjusted. So not being married to like your process or something you're comfortable with is definitely a key component of continual growth.
Yeah. So to try to summarize this for the listeners, start at the end. If you have an end, and you don't have to have an end, you could just be doing this learning. 7 years ago, 6 years ago, we didn't have like a detailed plan on, all right, in 2024, we're going to do this. But I do think once I got to the point of starting to think about that and working my way back, it did help. But start at the end. What is your 10-year vision? Is it a business you want to sell? Is it a business that you want to run profitably as a not a lifestyle business, but a business you just own and maybe hand down to your family? Is it a business that you want to eventually bring in another CEO over time? But get very clear on what is your perfect exit, and then start working your way back. So if the goal is to exit, and if you're a services business, it looks like this, or if you're a franchise, it looks like this, or if it's a software business, looks like this, you can go hire or for free bankers. So those that'll help you through a transaction, go talk to them, let them review your numbers, and they will tell you your skeletons or things to look out for. For example, with Elevar, I knew that we were very cheap in our industry, and that was reflected through our ACV, our annual contract value, or average money that we are earning per customer per month. We were so far below the average market price, and that was trickling down into our profitability over time because we want to hire better people, just give more value into our products, into our customers. But it was a red mark on us. Like your ACV is way too low. So we worked to improve that and improve that in less than a year, like doubled it. We didn't just go double the prices. There were a lot of changes that went into that. But so there are a few other metrics in our business that, again, just got insight from somebody that's outside of the business and worked our way back. And just to continue to summarize, so we don't need a summary of the summary, but that perfect exit, yes, define what are your skeletons, what are the metrics that you might need to focus in on, and then from there, it's just develop your 1-page or 1-year plan, 3-year plan, and just share with the team, execute against that. Yeah.
Let me jump in. That's a great point, because if you want to have a transaction in 2025, like you're already 4 months behind where you should be. So
yeah, exactly.
Go get a banker and have someone who's on your side of the table, who's working on commission for your sale, looking at your books, looking at your financials, and giving you the opinions of how you can improve those things before you have a potential buyer looking at your books and picking them apart. Because every time you have an issue in your business, that's going to result in a lower purchase price. So have someone looking at your books and your business a year before you really want to go to market. And I for myself, I think it was a great move to get a banker. Going out there with your business you've been building and working tirelessly to get to a point of acquiring and just doing it yourself, like you're still gonna have to run your business and hit milestones and objectives and everything while you're in due diligence and management meetings. Those are huge time investments. So go get a banker, pay them well, make sure it's a banker who has experience in your specific industry. Don't hire a real estate agent to sell a software company, but work a year in advance in order to get to this point, instead of just thinking you can show up and just throw your books out there in your company and just expect to get good offers.
Yeah, I think that's a great way to summarize it. And in case we didn't answer it, why, because I'm sure I have some colleagues and friends listening to this, why did we make this decision? It really just came down to, most people think it's because of burnout. You're ready to go do something else. You're like ready to like literally get out of the business. And that is the answer for many people. And that's why this decision for me personally, was not easy. That's why as Nate mentioned, we're having these 4-hour combos every night. And because I wasn't burnt out, still love Elevar, the direction of the company. We're growing faster now than we have ever been growing. Maybe not ever, but at the scale that we're at, we're growing significantly faster than I thought we would be. So it's not a market issue. It really just came down to getting really deep with yourself, like asking, like, what is going to make you happy? And I was able to come to that conclusion. Luckily, it worked out for us. But I thought it was helpful. I thought it'd be helpful to give that context where the point you sell doesn't have to be the point that you are ready to walk away from the business. And I know many other founders of businesses that have done the same thing, where they've either sold majority or all of it, and they stay on, and they've been relieved. They've gotten that financial pressure of, well, shit, what if I just worked 20 years of my life and invested everything and I have nothing to show for it? that concern is taken off of their shoulders, and now they're able to do what they love with their stress level now down at 0.
Yeah, and that's a really good point. Like, you should sell your business and list or go to market from a strategic standpoint, not a place of desperation. Because the people buying companies that have profitability and great revenue and great customers, they're very smart people, and they are very shrewd negotiators, and they're going to pick up on desperation. Like, that's going to come through in due diligence where you're tired, you're out of ideas, and that's going to show up as a risk for the business. Because if your business is founder led, if you're bootstrapped, all these things, and the founder and the person steering the ship is tired, that is an extreme risk to a business. So don't wait to the point where you're just out of gas. Go in there and be strategic about this. Get a banker early on, because our banker worked with us for 2 years.
Yeah.
And just provided a lot of like planning and like calendar work along the way, so that we took this chunk of time, 18 months went down to like 6-week blocks where we're going to work on our financials and we're going to go to market. If we don't get an offer, here's what we're going to do. And they work you through that so that you're not burning both ends of the candle, one from an acquisition standpoint and one from, just trying to run your business in the midst of all this like emotional roller coaster that is an acquisition.
Yeah. I'll share one other story. I think this was mid 22. Anyways, it doesn't matter. It was a couple of years ago in the summer, and I was at a burnt out place, and I remember my wife and I were in San Diego on a little vacation, and I had a call with Dan Martell, and that's basically what I said. I was like, Dan, I'm burnt out, man. Like, I put all this, 15 years in, and don't have anything to show for it, and don't feel financially secure. And my boys at that time were, I don't know, one and two. So I feel like I was letting them down. And he had such a great frame shift for me, which was, Brad, what do you want to do? What do you feel like exiting your business is going to give you in life? Write it down. Is that a $200,000 salary? Is it a $500,000? Is it $1 million? What is that? Get very clear on that. Number one, because he goes, in Dan's world, because there aren't very many people that I know that need more than $500,000 a year to live an exotic life. And he goes, Brad, I don't think you're that type of person anyways. So you're probably well below that. And it's right. And there are simple things like, I wanted to cryo and wanted a sauna and wanted to do more things like time. They're more time based. I want to exercise more. And he said, okay, well, you don't have to try to grow 100% every single year. Just slow down a little bit if that means it's going to take pressure off of you. So don't put those high growth goals and pressure on yourself. Carve out that time. So if you only grow 80%, okay, still a great business, still profitable. If you need more money, start taking profit out of the business instead of reinvesting it back in to relieve some of that financial stress. So that was, again, a couple years before, but having that conversation for me as a founder, it gave me comfort in that, okay, there are very small dials I can turn in my life to remove that stress right away. And I think I have an article on my site. Again, I shared this, but Nate, you and I are talking, and you're like, I don't know, it's 2:00 in the afternoon, and like we're talking, and you're like, hey, what are you up to? I said, I'm on my way to cryo. I got a month, unlimited membership. I'm doing cryotherapy every day. And you're like, damn, dude, that's ridiculous. I said, yep. I explained this story where I'm going to write down things that I feel like I can't do. I'm not giving myself permission to do until there's a financial outcome with Elevar, because I feel like otherwise I'm taking a step backwards. And I had that frame reshift in my mind and just started doing it. Did it change anything? Yeah, it made the business better. It made me a better manager, a better leader, versus coming in stressed out and with my team and customers.
Yeah, and that's something we heard before the transaction from a lot of SaaS company founders who are on the other side of the transaction. They said, it's not that much different. We kept expecting this like crazy outcome, and really, you transact, you get up the next day, your kids are still screaming, you and your wife have a busy schedule, all that. So don't expect this like delayed gratification perspective where you're just going to weather this storm and turn into a piece of leather. And then once you transact, then all of a sudden you're going to be able to just like resurrect this other person you were, because you're going to change and you're going to become a different person. You're going to have different desires that you don't even know yourself. So I remember in 2022, it was like, I think it was right around New Year's. You know, you always do these crazy planning things, and we can get into that in a later episode. But you told me, you know, what I want to work towards is, you know, if I had all the money in the world, what would my day look like? And you said, you know what, I'm going to go about every couple months introducing one of those things out of that day into my weekly routine. And I've repeated that to my wife so many times. And that's when I started training and working out again. Was like, you know, if I had all the time in the world, I would invest way more in my health, because I just turned into like this like skeleton. And I was totally dad bod, all this stuff. And, you know, okay, 6 months went by. I was into a routine training wise. Okay, I would probably get into the sauna more, or I would like turn off my computer at 8 instead of work to 9, so I could get to bed early and I can get up before everybody and just have an hour to myself every morning. So like over the course of 2 years of doing that, you're going to integrate some incredible things in your life, and you're going to be able to be that person who can strategically go to the acquisition table instead of someone who's just worn out. And then, you know, if it does work out that your company gets acquired, when you get on the other side of that transaction, you're going to still know who you are, versus being somebody who is like, all you ever know is just working 80 hours a week, because that's just like a shell of a human. That's no way to live. So those words to me from you in 2022 were like huge for me.
Yeah. So take that down. If you are operating your own business, running it, that can hopefully make a big impact. So Nate, you somewhat got us there already. What's changed post acquisition? And I'll just reiterate what you said. Not much. Yes, things have changed. There's more financial security, which unlocks things that you're able to do and afford. But at the end of the day, I'm the same person. My hobbies haven't changed yet. You still have the same things you want to do on a daily basis. And Patrick Campbell said this after he sold ProfitWell, when he was explaining it after he was post-transaction. And he said essentially, yeah, money is going to accentuate the best of you and the worst of you. So whatever you're doing now, money is just going to give you the opportunity to do more of that, whether it's good or bad. So if you have bad habits, it's going to give you more money to do more of those bad habits. I don't know, like the $10 tequila to $1,000 tequila, or the good habits of, you know, charitable volunteering, whatever it might be. And that resonates with me. And one other point to take from this is we intentionally and invested putting ourselves around a lot of people who were ahead of where we were. And that was a big takeaway from my first business. I thought I could just build it on my own and just strongman it, and it didn't work out. So the second time, when I first hired Dan Martell for $2,500 a month, we were doing $7,000 a month or $7,500. So
I remember when you signed up for SaaS Academy, I was like, man, that is a lot of money right now.
Yeah. And it was because there is a whole lot of stuff I don't know, but I know I need to get around people that do know that. And I'm just going to listen to them and just follow their advice. And that was the same leading up to post 90 days exit. Is there's just been so much learning that's gone into, not a whole lot changes, and you're just going to be able to do more of what you enjoy doing. And, you know, obviously you have the bad habits or whatever that you could accentuate, but just keep an eye out on that. And so that's probably my biggest takeaway post 90 days is, just not a substantial amount has changed from a personal mindset, feeling, whatever that means.
Yeah, and it's not effort alone that's going to get you there. It's skillful effort. So you paying the coach. You and I got into a rhythm there for a while where we were reading books. I had to read a lot because you read so fast. And so like every week you're working through this book, and we'd want to talk about it on Saturdays for 30 minutes. And there's a couple of times and I didn't read, and like I feel like you took these giant leaps forward. So, you know, realize that if you can't afford the $2,500 coach per month, then you can afford the $5 book, the Audible account. Like there's so many ways that people have packed great information. I mean, Hormozi's podcast comes to mind for sure. Free information. And if you just listen to all of Hormozi's podcast, your business would probably double. just from those free lessons there. So, it doesn't always have to come with a price tag. Someone like Dan Martell, I do think is definitely worth the money. But you just got to realize that you're not playing just an effort game. This is not just about force. It's about being skilled. So make sure that you're continually evolving, and you're also becoming a person who has the physical capacity to come to work every day and be very productive. And that this podcast, Brick by Brick, there's a lot of elements that go into growing a business, having a great outcome. You don't want to leave your family behind. You don't want to leave yourself behind health-wise, or bad habits.
Yeah.
So we're going to talk about all those things, because they all feed into having a company that grows to the point that you dreamt of, and having that outcome that you dreamt of, where it's lifestyle and it's just churning out profits every year, or you're getting acquired and you're, achieving that point that you set out to however many years before.
Yep. Yeah. So it's probably a good wrapping point. Yeah. I have an Apple Notes file that I've been writing down daily lessons. They're not quite daily now, but every other day, but for a while, every day, just writing on a lesson. What did I learn? Because I only pulled two lessons directly from first business to this business, which was I need a brand and I need to know how to make money right away. So this attempt of, okay, I'm going to start documenting what I'm doing just on Apple Notes of like, don't do this HR wise, or don't do this hiring wise. When you're going to hire somebody, do it this way. And when you're going to go into a market, do this way. But just documenting those lessons. So I can share that with others and share that with my boys and family, but also for myself in the future. So, future business, whatever, it's not just 2 lessons I'm taking forward from Elevar, and a lot of those will be pulling forward into this podcast. And the brick by brick, I still have Instagram stories that'll come up. You get like, hey, you shared the story 4 years ago, and it was 3:30 a.m. and it's just 2 pictures of a brick. It's like brick by brick, got to get it done. And those keep coming up, and that's a little bit of where the title came from. And it's not unique to us, so I see it all over the place. But I think Nate and I we still operate that way, even whether it's fitness, the High Rocks thing. It's just brick by brick. Just got to put a day's work in and get clear on standards, not goals, standards. What are the standards we're going to hold ourselves to? So if we hit those standards on a daily basis, it's inevitable for those goals to be achieved.
I can't take no loss. I don't even know what it costs.